Hello everybody, my name is Ty Bernicke, and today I'm going to be talking to you about two tax strategies in a down market. As we sit here today, the markets are down and there are some things that you can do to get a little bit of a financial benefit, and I'm going to be going over both of those strategies with you right now. And the first one is what many people call as tax loss harvesting. And to explain how that works, I'm going to explain how capital gains work. So capital gains are something that many people face if they buy stocks or stock mutual funds in non-qualified accounts. So the way I would define a non-qualified account is not inside of a retirement plan at work, like a 401k or a 403b, not in an IRA, not in a Roth IRA. So this is truly just a taxable account. Usually you can tell if it's a taxable or non-qualified account if you get a 1099 every year, regardless of if you take money out of the account or not. And so let's just say, for example, that we have a stock, and that stock A, if we put 100,000 investment into it, and assuming it appreciates in value to $140,000, if you were to sell that stock, you would have to pay tax on the $40,000 gain because you're recognizing that gain. And you would have to pay capital gains taxes on that amount depending on your level of income. If you're very low income, you might not have to pay taxes on that, but most people would have to pay taxes on that capital gain. And the capital gains tax rates are either 0%, 15%, or 20%, depending on your taxable income and your filing status. Now, similar to capital gains, there's also capital losses. So for this example, we'll assume that somebody had $100,000 investment and that stock declined in value to $50,000. If that person decides to sell that stock, they will have a capital loss of $50,000. That capital loss can be used to offset gains up to $50,000. So if in that same year they had a stock that was up $50,000 and they had a stock that they sold and they had a loss at $50,000, if they recognized the gain in the same year as they recognized the loss, the two would offset each other. But what happens if they don't have $50,000 of gains to use the $50,000 of losses to offset against? Well, you don't simply lose that loss. Imagine that it goes in a bucket, and that bucket can be used to offset any future gains or up to $3,000 per year of ordinary income. So every year, if you start off with $50,000 of losses and assuming you have no gains, you could only offset $3,000 of ordinary income and take a deduction against your ordinary income for $3,000 each and every year until that $50,000 is used up. Or if in the future you have a gain, you can use the entire amount that is left in that bucket to offset that gain in the future. So if you have some of your securities that are in that taxable type of investment, that non-qualified investment, and the markets are down, it might not be a bad idea to harvest those losses so that you can use it as an income offset up to $3,000 per year, or to save it for future years when you do have gains. So the second strategy that can be excellent in a down market is a Roth conversion. Again, everybody's situation is unique. Roth conversions don't always make sense, but if you're in a situation where it does make sense, a down market can be an opportune time to use a Roth conversion. And a Roth conversion basically occurs when somebody takes money from an IRA and converts a certain amount. When they do that, they're going to have to pay a tax on the converted amount that goes into the Roth IRA. But once the money is in that Roth IRA, it grows tax-free indefinitely into the future until money is withdrawn for qualified reasons. Then they can take out all the gains and the original investments out completely tax-free, where if they leave that money in the IRA, obviously that money is growing and growing and growing, and eventually they'll have to take it out, or their beneficiaries will have to take it out, and all of that money will be subject to taxation. So the Roth IRA provides a sanctuary from income taxes in the future. And to illustrate why this could be beneficial in a down market, I'm going to use two examples. And in the first example, we're going to assume that Joe had 100 shares of ABC stock. and it was worth $30,000 in an IRA, and he decided he wanted to convert that $30,000. But before converting the 100 shares, that stock increased in value to $36,000, and Joe decides to convert the whole $36,000, and he's going to have to pay tax on the $36,000 as he's putting it into the Roth IRA. Now, conversely, if Joe had 100 shares of ABC stock worth $30,000 in an IRA that he decides to convert, and instead of it going up before the conversion, it goes down and it shrinks in value from $30,000 to $24,000. Well, if he converts $24,000, he's going to have to pay tax on that $24,000, but it's better to pay tax on $24,000 than $36,000. If after the conversion, this $24,000 subsequently grows to $36,000, well, all of that growth is tax-free. That's $12,000 of tax-free growth. And that is the reason why it's beneficial to convert when the markets are down, because you're converting those shares at a lower price and therefore paying less taxes. Hopefully, those are two strategies that you can utilize in your own financial situation during this down market. If you have any questions or you'd like a quick chat with one of our financial advisors, you can click the link below, or you can visit us at Bernicke.com. Thank you.